Okay, we're live on YouTube. The panel can start.
Good morning, good afternoon, and good evening to all of you. As a very first course of business, let me say a quick note on interpretation. There's a globe icon at the bottom of your screen to select your language, English or Spanish. We suggest you mute the original audio. And with that, let's get started. Thank you so much for being with us today. My name is Alexandra Haas, and I will be moderating the debate today organized by the G24 and the Independent Commission for the Reform of International Corporate Taxation, the ICRIT. The G24, or the Intergovernmental Group of 24, is a forum to coordinate the positions of developing countries on issues related to international monetary affairs and development, and to achieve a greater role in discussions in relevant global forums. It was initially created as a chapter of the Group of 77. The ICRIT is a group of leaders from around the world who believe that at this moment in history, there is both an urgent need and an unprecedented opportunity to bring about significant reform of the international corporate taxation system. The ICRIT was initiated and is supported by a coalition of civil society and labor organizations, including Oxfam. We are thrilled to be here today at such a crucial moment in global tax reform. It is not that often the tax is so prominently occupying headlines on international media. On the 1st of July, the G20, the Inclusive Framework, announced high-level global tax agreements to ensure multinational companies pay their fair share and introduce a global minimum tax to end the race to the bottom. A number of countries, including Nigeria and Sri Lanka, did not endorse the deal. Negotiations have since continued, and 140 countries are meeting this Friday, tomorrow, to decide whether to endorse a revised version of the July deal. If endorsed, then it will be taken to the G20 meeting in October. While the agreement on Friday will not mark the end of the negotiations, this webinar is a timely opportunity to consider who is this deal really for. Some of our speakers today will be busy, and we are extremely lucky to get them with us today to break down the details of what will be taking place in the coming days and months. We have heard a lot of the voice of the rich countries, and now it's also time to hear how this will impact the rest of the planet, emerging and developing economies, and average citizens around the planet. Before we get our speakers, let me just highlight some housekeeping points you'll want to remember. This debate will be a total of 1 hour. It is live streamed, and the video recorded will be made available after. The last part of the event will include a Q&A to bring in questions from journalists. Please type your questions by clicking on the Q&A icon, not the chat box on the side. Please provide your name and your outlet and who your question is for. You can type your question in English, in French, or Spanish, and do so while the panelists are speaking. You don't need to wait until the end. Once the panelists have finished speaking, I will read out your questions to the panelists. So let me introduce our distinguished panel. We have one representative of the G24 countries. We have Raúl Rigo. He's Secretary of Treasury at the Ministry of Economy in Argentina. Thank you, Mr. Rigo, for being here with us today, and good morning. And then we will have three representatives from ICRIT. We have José Antonio Campo. He is the chair of ICRIT and a professor at Columbia University. He's a former Minister of Finance of Colombia and a former United Nations Undersecretary General for Economic and Social Affairs. Welcome, Mr. Ocampo. We will also be joined by Joseph Stiglitz. He's an American economist and a professor at Columbia University, Nobel Prize winner and former senior vice president and chief economist at the World Bank, and a former chairman of the US Council of Economic Advisors. Our fourth speaker is Jayati Ghosh. She's a professor of economics at the University of Massachusetts at Amherst. She has advised governments in India and other countries, and she is the executive secretary of International Development Economic Associates. Welcome to you as well, Professor. So let me start with a question to all of you. The G7, first, 134 OECD IF countries, the G20 last July issued a statement that covers the main elements of the two pillars: the scope of companies and sectors to be covered, the percentage of profits to be reallocated, the rollback of unilateral measures, and an arbitration mechanism in conflict resolution. A new statement likely to come out of the inclusive framework on Friday. Let me start with a quick and straight question to you. Is it going to be a historic deal? Is it what you were expecting? Is this the kind of reform we need? And Professor Ocampo, let me start with you.
Thank you very much, and thanks to you, Oxfam, but also, of course, the G24 for supporting this meeting. Let me say that there were very high expectations on this process, which of course is a continuation of previous negotiations that led to a 2018 convention on tax cooperation. And it's of course essential to stop the race to the bottom, to guarantee that the firms pay taxes in the places where they operate, and also to the regressive effects of tax evasion that has characterized the world economy for some time. Now, the most interesting proposals to advance this further have actually come from the group of 24. Several countries from the group 24 have been making proposals as a group, and others also individually. But unfortunately, most of those proposals, and we'll see that, have not been accepted. And we are basically on the G7 agreement that was endorsed by the G20. And let me say that it's an advance, of course, in terms of international tax cooperation, but it's very limited in the scope, and particularly the effects on developing countries are quite limited. And I think this is a major point, given that developing countries depend much more on corporate income taxes than developed countries.
Thank you, Mr. Ocampo. Now to you, Mr. Rigo from Argentina. You, the minister, have been in the room around the table of negotiations. The deal potentially restricts the ability of countries like Argentina to implement unilateral measures to tax digital businesses, including a solution for only 100 companies. Some of them don't trade in developing countries and asks countries to accept mandatory dispute resolution. Would the deal provide enough revenue to call it historic?
Good morning, Alexandra. It's Minister Martin Guzman here. So I managed to connect for just a few minutes. I have a commitment with the president, who is kindly waiting, so I could speak for at least 2 minutes, and then Raul Rigo will continue. But given the work that ICRIC and the G24 have been doing, I thought it would be very, very important to at least share some of the views on what's been happening in the negotiations. So with respect to your questions, let me be very straight. We policymakers from developing countries are sort of forced to choose between something bad and something worse. Worse is to get nothing, and bad is what we are getting. It's very little. We are not using this opportunity to actually correct one of the most toxic aspects of globalization and digitalization of the economy, which is tax avoidance. So what Argentina as a compromise is accompanying the proposal, but we have expressed a number of concerns that will need to be addressed while the instruments are being developed. Particularly, we have noted that at times, the methodology to assess the impact of this global solution hasn't been transparent. And we should have access to the database that is used to assess the impact of the proposal. The details matter, and we won't be able to have a precise sense of how the system will work until we have a precise definition of all the details of the solution. And some of the aspects of the proposal that had been endorsed in June of this year before the G20 meeting in Venice, still that were concerning from the viewpoint of developing countries still remain, and some of them have even gotten worse. Particularly, we are still concerned with the lack of proportionality between the commitments that developing countries are being requested, as for instance, the prohibition of unilateral measures for a universe of multinational companies that goes beyond the scope that is included in the Pillar 1 of the proposal, and on the other side, the benefits that this proposal will bring to developing countries. We don't see a concomitancy between the commitments and the benefits. We hope we can continue working over the next few weeks in order to find a resolution to the problems we are facing. So instead of just giving a small positive step, we can give a much more important and substantial positive step towards a solution. Thank you very much. And unfortunately, although I will wish I could stay, I will need to leave. I'll leave Raul to continue the rest of the session.
Thank you, Minister. I apologize. I didn't see you for a minute. Minister of Economy for Argentina, thank you so much for making the time. We will be here, and thank you, Mr. Rigo, for joining us as well. So, Professor Ghosh, going back to you then, do you think this view is shared by other developing countries? Your microphone, please.
Forgive me, we keep making this mistake. I think what Minister Guzman has said is absolutely correct, that many developing countries are agreeing to this, not willingly, not happily, but because really they're faced with the worst option of nothing happening. We are obviously in the midst of one of the biggest global crises that we have seen for a very, very long time. Developing countries already have much less fiscal space because they cannot afford to run the large deficits that advanced countries are running, because they would experience capital flight and downgrades and so on. So it's very important for them to have access to more revenues. The current proposals do not do that. They really concentrate all the additional revenues in the north, and they do not provide meaningful additional revenues to most developing countries. This need not happen. It is actually possible to go beyond this current system. I think, the whole issue of transfer pricing, the arm's length approach to taxation, that principle being rejected, the principle of a global responsibility for the tax, that's a very important principle to accept. And so we all welcome that. But it doesn't still eliminate the tax competition, because there are far too many loopholes in the current situation, and the ways in which it's being implemented will really provide hardly any additional revenues. This could have been different. The G24, as Professor Ocampo has already mentioned, put in very useful proposals. There were many other proposals from developing countries. These have not been accepted. The G7, G20 proposals are simply not ambitious enough. And at the same time, they also want countries that are participating in this to restrict other unilateral measures that they could help them to find some additional revenues in the absence of a solution. For example, the digital taxes that many countries have already imposed. So I think it's definitely very inadequate. Many countries are extremely unhappy, but they are forced to go along with this really because the other option is no progress at all.
Thank you, Professor. And now to you, Professor Stiglitz, thank you for joining us. We were speaking about whether this is going to be a historic deal in the terms that it was stated in July and the way that negotiations are going. And you have been critical on your analysis. Can you please give us your point of view?
Well, I just picked up the last part of Jadi's comments, and from what I've seen, she's absolutely right. Let me frame it somewhat differently. If we were discussing within the United States a major change in tax law, one part of that, before there was any discussion of adopting it, we would do an analysis of distribution. Who is going to be benefited? Who's going to lose? What are going to be the full consequences of this in terms of real economic activity, who pays more, who pays less? I think it's just so disappointing that they are asking countries to sign up to a blank check, to sign up without knowing how this is going to work out. Now, I don't want to sound paranoid, but I think the reason that there has not been this kind of deep analysis is that if they did that, it would show this is not a major change, and it's not a pro-developing country, pro-emerging market change. It is, you might say, the smallest change that can go under the rubric of change. They want to change the facade, but not really change what is going on. At one level, one can understand the European countries said it's unacceptable that your digital giants are doing so much business in our territories, jurisdictions, and not paying taxes. So we're going to start paying them. And the United States, always reluctant to change the tax system, said, we don't like that. And they had no good argument. And so it went to this tough negotiation, but it was really a negotiation based among the advanced countries, which is what we've seen. After 2008, there was a recognition that the treasuries of the advanced countries had been hurt by the tax havens. And so they wanted to close those loopholes. They were concerned about their own revenues and closing those loopholes. And now in the United States, there is a similar concern that we need to raise our corporate income tax. The revenue raised by our corporate income tax as a share of our total tax revenue has gone way down. And there is a fear that unless there is a global minimum tax, we will be put at a disadvantage. Whether that's true or not, that reality is shaping, I think, the politics. And so the global minimum tax has to be seen in that light. It makes it more acceptable for the United States to increase its tax rate from 21% to 25 or 28%. If there's a floor of at least 15%. So one has to see what is going on in the context of the politics and the needs of the advanced countries. The implications for the developing countries and emerging markets are really second order. That is not what is driving the current negotiations. If that perspective is correct, it leads me to the view that the developing countries, emerging markets, if they stick together, if they say, we will accept parts of that agreement, but not all of it, our voice hasn't been heard. The benefits that we get are not commensurate with the obligations that we're being asked to undertake. Shadi mentioned the fact that while the sharing of the allocation of rights to tax in Pillar 1 affect only a relatively few companies and are being done on a basis of a view of profits that no economist would accept and done in a minimal way. And in return for that minuscule reform in Pillar 1, they're asking developing countries not to impose any taxes on the digital giants or on a digital firm from America that's not a giant, if it's a small firm, and takes away revenue from the country. That's clearly an unbalanced agreement. And so I think the way that developing countries and and emerging markets should respond is to frame the response to be a commensurate obligation. If you share the revenue of those 100 companies in a fair way, we will agree not to tax them. We understand the principle of double taxation, so we can, make that kind of statement. We'll go along with that, but we're not going to tie our hands on all of our taxation in response to you're doing something for a minuscule amount on, as somebody was saying yesterday, $10 billion we're talking about, a minuscule amount for the world's largest corporations from which we may benefit very little. And then you're asking us to have mandatory arbitration dispute resolution. And without a well-developed understanding of the way that dispute resolution is going to work. If you're going to be the judge, well, I'm not sure I want that to be the way it's going to work out. So I think what is being asked here is incommensurate with what is being given. And I think at least the developing countries and emerging markets might say at this juncture, we will go along with certain provisions. We will agree to a minimum tax, but with certain carve-outs. You have certain carve-outs that are concerned with your special interests. Your special interests are like finance or other areas. We need a carve-out for our development needs. And so the way it's been framed has not heard our voice enough. I do think it's important for there to be an agreement to say that the basic framework of a global minimum tax should be accepted, and that it should be accepted of at least 15%, and for them to characterize this agreement as an interim agreement where you want progress to continue. We want progress to continue moving away from the transfer price system. We want progress to be made to stop the race to the bottom. But we have to, I think the voice that this particular agreement has not done enough to give voice to the concerns of developing countries and emerging markets. And so it's not ready. All the details are not ready for prime time for a global sign up. But that doesn't mean we don't recognize the big step forward in closing some of the loopholes and setting a framework for a minimum tax and moving away from the transfer price system.
Thank you, Professor. Let me, we know that there are, as you just said, still elements to be agreed upon. And, I would like to know what you see as the most challenging, the cornerstone of the negotiations, and what could have the potential to change the real dimensions of this reform. And let me go to you, Mr. Rigo, and ask you, it looks like Ireland has managed to convince other countries to drop to at least 15%, and now it's only 15%. You mentioned before that we should aim for a higher rate, close to the 21% Biden originally proposed, or the 25% that the ICRIT would like. This is a big issue for many emerging countries, as Professor Stiglitz just described, that see a low minimum tax rate as unlikely to be a deterrent against profit shifting. Mr. Rigo, can you comment on that, please?
Yes, of course. Thank you. Argentina, as you know, has asked for a high minimum effective tax rate of at least 21%, but preferably 25%. However, most of the members support a tax rate no higher than 15%, to the point that at the 30th September steering group meeting, the tax rate of 15% was suggested by OECD Secretariat and supported by all members except for Argentina. It should be noted that the minimum effective tax rate under Pillar 2 does not mean the level of corporate taxation that should be imposed in every jurisdiction. It is just the level below which the globe rules of Pillar 2 are triggered to allow taxation in jurisdiction implemented such rules where another jurisdiction taxes an entity below the agreed minimum effective tax rate. In such case, given the rule order decided by the inclusive framework, the additional tax will be collected in the jurisdiction where the ultimate parent entity of a multinational is located. And only if such jurisdiction does not apply the globe rules, such taxation may be levied in other jurisdictions from where the base eroding payments were made, despite Argentina's unconformity with this rule. What we're trying to say here is, as our minister said earlier, we think the work done by all the countries is very valuable, but it is not enough for developing countries. We are seeking for higher rates for taxation, for the digitalization of the economy, and we are hoping to keep working with the other countries in order to get that goal.
Thank you, Mr. Rigo. And let me go to you, Professor Ocampo. There's a fear between developing countries that this will mean just more money for richer countries. Is that a real concern, and can something be done about it?
Well, as Mr. Rigo just pointed out, let's say the headquarters of the multinationals are going to benefit from this rule. Which means, I mean, there are of course multinationals from developing countries now, but most multinationals are from developed countries. So this will benefit mostly developed countries. And this is what has come to be clear in all the estimates that have been made of who will benefit from that. This is why, by the way, the G24 asked for something that will allow the countries where they are producing to use withholding taxes on some of the mechanisms, payments that they made between the different subsidiaries of the multinationals that are used as mechanism for profit shifting. Which means, aside from interest payments, which are already allowed, basically services and capital gains, because those are two mechanisms that are not subject to withholding taxes, and are particularly services are widely used by multinationals, and to transfer prices, reduce the payments in the countries where they are actually producing. This will be a mechanism that will really benefit developing countries. It has not been agreed yet. We hope there is a possibility of that. Let me say, however, that one of the effects of this, in order to implement this, there has to be a new convention that can change some of the existing bilateral tax treaties. In a sense, like the 2018 convention that allows also to or affects these bilateral treaties. And of course, whether this is possible or not is a big question mark, but this should clearly be in the agenda. How to share the benefits more widely with countries where the multinationals are located, producing for global markets. By the way, one particular issue is the case of the United States, if there is a convention, which could be actually also a UN convention that has been proposed, for example, by the panel on financial transparency that the UN convened, in which I was a member, that we proposed that it should be a UN convention, a UN tax convention that could include this provision. In a sense, also following on some of the proposals of the UN Tax Committee, which are much better than some of the agreements that have been reached in the OECD inclusive framework. But it could also be a follow-up to the current negotiations, and hopefully it will be agreed during the current negotiation. But that is not that is hard to do at this stage.
Thank you, Professor Ocampo. And let me go back to you, Professor Stiglitz, and build upon what you were saying a moment ago. One of the big debates is whether the world can accept gradualism or whether the COVID crisis calls for more ambitious and comprehensive reform in the way that multinationals are taxed. Could you please comment on that?
Well, I think the world needs something dramatic, but it's quite evident from what we've seen out of these negotiations that we're not going to get it. So we can't let the perfect be the enemy of the good. So I think, but I think the remarks that have just been made highlight the extent to which this is a pro-advanced country agreement. That if one were to have asked me who should have priority if there is a deficiency in the payment of a minimum tax, should it be where the goods are produced, activity actually occurs, or should it be in the home country? It would seem natural that it would be where the actual economic activity occurs. And yet this agreement says that if there is a deficiency in the payment of the minimum tax, the first recipient should be the home country of the corporation. One thing that has not been emphasized so far enough is my worry that what began as an initiative to make multinationals pay their fair share will have just the opposite effect. Because if you announce a global minimum 15%, I'm afraid that at least in many quarters, that will become the maximum. People will say, if we charge more than that, we won't get business. And so a very large fraction of the countries will choose to go to 15. It becomes a coordinating point. And so, in fact, what will happen is the de facto rate will be something more akin to what Ireland charges, which is 12.5%. So Ireland will have raised it officially to 15%, but that's a small change as opposed to those countries that were trying to make sure that corporations paid their fair share of taxes and get the rate up to 21 or 25%, as Ikrit said. I think one of the questions that we need to discuss is that if this particular set of provisions go forward, are there ways that the developing countries and emerging markets can impose taxes consistent with the bilateral tax treaties that enable them to recuperate the revenue that they might otherwise have lost?
Thank you, Professor. Professor Ghosh, now to you. If this deal is seen as not equitable or it is not equitable, do you think this sends a bad signal to the global community?
Oh, absolutely. And I think it's already been identified very clearly the many ways in which it isn't inequitable. Let me just say, frankly, I think if you look back on this subsequently, future historians will see this as a time when G7 was really shooting itself in the foot geostrategically. When, whether it is grabbing global vaccines or grabbing all the available global taxes that can come out of any new deal, it's not appearing as an agency that actually is, if you like, leading the world, but rather leading a set of rich countries that want to keep enhancing their share of every possible pie. And that's never a good look, for sure, but it also dramatically will reduce their influence in the developing world. I think Professor Stiglitz mentioned right now about how 15% could become a minimum. Most developing countries have got tax rates in excess of 20% on corporations. This is like an open invitation to force you to cut it down. Because, of course, the incentives for multinationals to then play hardball with developing countries are so much greater. And they can always continue to do precisely the kind of base erosion and profit shifting that we have already seen dominating so much of their activity. So for developing countries, it could appear as, really the rich countries operating in bad faith, that you have to sort of, grin and bear it and go along with it, because otherwise even that principle of a global taxation is lost. The principle of unitary taxation of multinationals would be lost if you don't go along with this. But it is not something that is either going to enhance any kind of moral ethical standing or even any strategic standing. Developing countries, if not immediately, will definitely look for other avenues over time. And those could also be other strategic avenues. So I think, in a sense, I would argue that G7, in seeking these short-term gains for its own tax base, is actually losing sight of any advantages that it could hope to get from a global economy that is more prosperous, or from its own influence in the wider world.
Thank you, Professor. And before we open this up to questions from the audience, and let me remind the audience, the journalists, that you can type your questions in the Q&A box. Let me do a final round, and let me start with Professor Stiglitz, because I know you have to run in a few minutes. What do you expect that will be happening in the coming days and at the OECD Inclusive Framework Plenary? And particularly, Professor Stiglitz, could you give us some light on what will be happening in the US and in your favorite tax haven, Ireland?
Well, I think, obviously the advanced countries have been playing very hard ball, as Jadi said. They have looked at this very narrowly from the perspective of solving their immediate problem. Their immediate problem was this conflict among the advanced countries about taxing the GAFA, the tech, and they see this as a way of solving that problem without any vision of what kind of world we want. Without any kind of vision of what would be a fair tax system that would promote economic growth. Without recognizing, for instance, that it's going to be, in this world of tight budgetary constraint, increasingly difficult to get development assistance through parliaments and Congress. And so recognizing that reality should have said, well, we ought to make sure that the developing countries and emerging markets have resources of their own. And that would even be better. Let's make sure that the tax system allocates the global profits, which are a joint profit. Let me put our joint profit of these multinationals are a joint activity occurring in all countries. And the profits, therefore, need to be allocated across the countries, that the system should be and these are pure profits, because remember, the nature of the corporate profit tax is you deduct labor, you deduct In the United States, you deduct even the cost of investment, you deduct interest. So these are what economists would call pure profits. You want to make sure that the allocation of those pure profits goes fairly to emerging markets and developing countries to make a more prosperous world. And you want to make sure that that tax rate is high enough to sustain their economic growth, especially in the aftermath of this dramatic event of COVID-19, where they have been hit, many of them much worse than the advanced countries. And they don't have the resources to revive their economy that the advanced countries do. So in a world where we are risking at this particular moment divergence of the developed countries doing a recovery that is more robust than the emerging markets and developing countries, in the midst of this possibility of a divergence, to have a tax agreement that exacerbates that divergence is economically foolish, morally reprehensible. And so what I hope what they will do is to say, let's put a pause button on. Let's agree on some things that we can all agree. For now, maybe 15%. Ireland has bargained hard, but that's not the end of the discussion. This is just an interim. So for now, 15%, but going forward, we have to recognize that going to have to be more than 15% of profits. And we have to make sure that before we adopt, as I said before we adopt anything as a global agreement, let's make sure we understand fully its distributive implications. Let's do an analysis. And the fact that you would rush to something, to an agreement that is the implications of which have not been adequately analyzed, I find very disturbing.
Thank you, Professor Stiglitz. I apologize. It seems there is no Q&A icon, so please write your questions in the chat box. And let me go to you, Mr. Rigo, and building on what Professor Stiglitz and Professor Ghosh have said. You have tough work here. Do you think there will be anything in the deal that will be satisfactory or relatively satisfactory for Argentina and Latin American and emerging countries across the world?
Well, as we have said, we share the need to restore the international tax system in a way that multinational companies pay their fair share of taxes in those jurisdictions where businesses are conducted, allowing those jurisdictions to raise enough revenues to finance pro-growth and inclusive policies. We do recognize the efforts made by the steering group, although we remain concerned about a number of aspects of the proposal that could undermine the goal of establishing a path to address tax challenges that arise from the digitalization of the economy, especially for developing countries. As we said before, we've been active in trying to explain and share those concerns. Unfortunately, those concerns haven't been heard so far. So we have to keep trying to, make ourselves heard and try to improve the global solution towards the interest of developing countries. From the viewpoint of developing economies, we have endorsed the proposals of the steering group. However, the commitments that developing countries are being requested are unlikely to be commensurate by the benefits of the proposal. So that's what we think. Thank you.
Thank you, Mr. Rigo. Professor Ghosh, other comments on what this means for developing countries?
Thank you. Yeah, I think there are several areas of concern for developing countries, exclusions and inclusions. Exclusions, I think we have already identified the fact that only the top 100 multinationals are even considered in this process, the fact of the low minimum tax rate and so on. But there are important inclusions, which mean the developing countries would actually end up losing quite a bit in some cases. That's why countries like Nigeria and Kenya have already opposed this deal. There are two important issues, I think. One is the insistence that all countries give up any alternative tax measures that they have imposed, such as the tax on digital companies, which would dramatically affect a number of countries that already have fairly significant revenues from this. But the other is that in Pillar 1, there is a new form of mandatory dispute resolution. Now, this is going to be administered supposedly by the tax authority of the home country, and it will consult others only through panels. All the disagreements are resolved by this mandatory dispute resolution. And this is actually something which is of deep concern, because developing countries, we have terrible experiences with mandatory arbitration. We have very little faith in many of the international panels that have been set up. These are panels that will be driven by the interests of the home country. And yet they are going to be necessarily determined and necessarily determining the outcomes, so that there is no kind of alternative way in which the developing countries can resolve these disputes. That's a very large thing to give up for what is, as has been pointed out already by Professor Stiglitz, by Professor Ocampo, that we don't even know the numbers. We don't even know how much they can lose. And if they can lose all these indeterminate amounts, and then it will go into disputes that they have no control over. These are really major, major changes, which cannot be made in good faith, just assuming that everything will be all right. So I think developing countries have genuine concerns. I think perhaps what is important is to agree on the principle of a global unitary tax on multinationals and the principle of a minimum tax on corporations, and then see how you can develop that in your own countries and your own regions in different ways.
Thank you. Thank you, Professor Ghosh. And just to close off this round of questions, Professor Ocampo, so will this be the end of the road, or do you already anticipate other rounds of negotiations?
Well, I guess given the frustrating character of this agreement, at least developing countries should get the commitment for a next round of negotiations, which will manage the pending issues. I mean, hopefully, the best scenario will be that in the drafting of the resolutions from the current agreement, developing countries could include some of their concerns into the draft. I think this is difficult at this stage. I mean, what we have seen is essentially that the G20 endorsed the G7, and the OECD Inclusive Framework endorsed the G20, and now there's a further endorsement, let's say, of the originally G7 agreement. I mean, hopefully there could be changes in the drafting, which will continue next year. Now, going forward, as I said, I hope at least there will be a next round of negotiations. And there were prior ones in BEPS, so there is no reason why there could not be further ones. I really hope that the next leaders, the next heads of the G20, which will be Indonesia and India, will endorse the idea of further negotiations. And as Sigrid has pointed out, that the UN panel has also there is a possibility of a UN convention that some developing countries should probably pursue as an alternative. Of course, that's not an easy road, but at least it recognizes that the UN is a more legitimate body at the international level than the OECD Inclusive Framework, because it's a universal body, basically, in terms of a membership of countries. I mean, we have in ICCIT all the time pointed out that the future of international tax cooperation should be under the United Nations, not under the OECD. I mean, that's not an easy decision, of course, because it was the It was really the G20, in a sense, again, forced by the G7 that in 2012 decided to give this whole round of negotiations on BEPS to the OECD. But I hope that this issue will continue to be in the agenda. And the very least, in my view, is that there should be a new round of negotiations under the OECD inclusive framework.
Thank you, Professor Ocampo. Professor Stiglitz, if you have a minute before you leave, I have a question from the audience, from Fabian Grasser from Mediapart in France. He says, in the light of the Pandora Papers, which reveal the extent of tax evasion, what would be, according to you, the most obvious solutions to combat tax evasion and money laundering through offshore companies, given that measures such as the exchange of information, the strengthening of controls by financial intelligence units, or the publication of registers of beneficial owners are proving to be insufficient, if not ineffective?
Well, I think they are insufficient, but they are a move in the right direction. I think one of the things that needs to be highlighted is that a lot of the tax avoidance occurs in developed countries themselves. In the United States, there are tax havens, the real estate sector in the United States and in other advanced countries. So we have to hopefully put much more energy into this issue of tax avoidance than we've had. We've been having all this discussion today as if that we know where the money is going and we can actually tax it. But with all the secrecy that the Panama and Pandora Papers have shown us, we recognize that we don't have that kind of transparency. Now, one of the things that's going on right now in international financial markets in the opposite direction is the development of Bitcoin and other cryptocurrencies. And one has to see this as part of the long run battle. Do we have transparency in financial markets that is absolutely necessary if we're going to have a global tax system or not? And if we're going to have transparency, we have to strictly regulate cryptocurrencies. We shouldn't be opening up a new avenue for avoidance and of secrecy. And so it seems to me that while what we've done is not enough, it is moving in the right direction, particularly if we embrace the developed countries and much more the real estate sector. And this beneficial ownership that you referred to is part of that.
Thank you, Professor. And another one for you, if I can have you for a couple of more minutes. This is from Sarah Collins from the Irish Independent. And she asks, do you have any sympathy for Ireland's fears that it will lose future investment because of this deal? Do you think this will do anything to reduce companies' use of Ireland as a conduit for tax avoidance via other countries, as revealed in the Pandora Papers?
So first, let me make a distinction. A lot of the tax avoidance does not give rise to real economic activity. It's only where the income is booked. So that when all of Europe's income from Apple was booked to Ireland, it created maybe 300 jobs, a few hundred jobs, and gave a minuscule amount of extra revenue to Ireland at the cost of enormous amounts of money from the rest of Europe. So it's a non-zero sum game. It's a non-zero sum game in which Ireland gains a little and the rest of Europe loses an enormous amount. So yes, there will be some consequences, but I think Ireland has a strong record of creating, a highly educated labor force. It's made the right decision in staying in part of Europe as opposed to its neighbor UK. So it's an English-speaking country at the that is part of Europe, of the EU. So I think these worries are greatly exaggerated. And one of the experiences that I had at the World Bank was unambiguous. Tax competition, the real beneficiaries are the corporations, not the countries. And that it is better for Ireland and for the world if one competes on the basis of a race to the top, the quality of the labor force, the quality of the rule of law, the quality of the infrastructure. More tax revenue means you can have better investments, health of the people. And those are the basis which will be the basis of the long-run prosperity of Ireland. And I have every confidence that Ireland will actually do better in this world where the model of growth is based on taking advantage of your neighbors.
Thank you, Professor Stiglitz. And let me ask Mr. Rigo if you can comment on this question related to Ireland, but also let me read out a question from Stephanie Johnson from Tax Notes. She says, I understand the OECD had provided countries a tool to help them run their own impact assessments of pillars 1 and 2. How does Argentina expect pillars 1 and 2 to affect the country specifically? And then I'll read another one for the other panelists. Please, Mr. Rigo.
Thank you. Yes, that is so. Yes, the OECD has provided us with actually 2 toolkits. Unfortunately, the data and parameters of those toolkits are not current. I mean, they're a little bit old. They have some biases, and those circumstances, as Mr. Guzman said earlier, deprived from some transparency, so we are not able to be accurate on the real effect of Pillar 1 and Pillar 2 on our tax system and our revenues. So that's what we are talking about, lack of transparency, and we are asking OECD to provide us with a fully integrated toolkit to help us understand the effect of the global solution on our economy.
Thank you, Mr. Rigo. And now let me go to you, Professor Ghosh, and ask you the second part of Stephanie Johnson's question from Tax Notes. What should be the future of the inclusive? What should the future of the inclusive framework be going forward?
This is, of course, a difficult question, but I think what's important to remember, so far we've been phrasing it very much in terms of advanced countries versus developing countries. But actually, it's what Professor Stiglitz just said. It's people lose out. Governments and taxpayers lose out from tax deals that essentially benefit corporations. So while this tax deal is in that sense an important step forward because it does recognize the principle of global profits being globally taxed, and it recognizes the need for a minimum tax, it's a major loss even to citizens of the developed world. I mean, there are calculations by the European Tax Observatory which show what a dramatic decline in tax revenues is available even in the developed world if you move from a 21% to a 15% rate of minimum tax. It dramatically changes the revenues that are available even in advanced countries. Similarly, restricting this only to the top 100 multinationals and then to some peculiar notion of excess profits, which, as Professor Stiglitz says, is never used anywhere in any tax situation in any country. That is a massive restriction which hands over more money once again to large companies, to multinationals. And so taxpayers are losing because eventually it comes back to bite them. And so I think really it should not be seen only as an issue of developed versus developing countries. It's the interests of multinationals which are being protected at the expense of people across the world. So there must be a much wider movement of people demanding that this tax deal delivers something much more, which it can easily do. The solutions are all out there. The proposals are now well known. It can easily deliver much, much more in terms of tax revenues that can be usefully utilized to meet the basic needs of citizens in both developing and developed countries. And I think that principle should not be lost. That notion that a global tax deal has to benefit people in a country and people across the world, that is something which we have to push much more. And I think the future of these tax negotiations will depend on the extent to which people in their own countries succeed in pushing their governments to recognize this and work towards this.
Thank you, Professor. Let me just follow up with a question to you before I give the final remarks to Professor Ocampo. But first with you still, Professor Ghosh, do you think, and this is a question from the audience, do you think Biden and the other G7 leaders led by example, changing the legislation that protects tax avoidance in the Delaware, Bahamas, Virgin Islands, or will they only ask other administrations to do so?
I don't know if I'm the right person to answer this because I don't know what's going on in the Biden administration. But let me just say this as a general principle. I think governments anywhere in the world don't do things because they are good or they suddenly see the light or they suddenly. I think governments do things when popular mobilization forces them to. And so I think if the Biden administration behaves in a certain way, it's because there isn't enough popular mobilization to force them to change that. Or if it behaves in a progressive way, it's because there is enough of a demand in society and through a lot of active, a lot of activism that actually demands a certain thing. So I think the initial statement of a minimum tax rate certainly came from good economic principles. The announcement of a 21% tax rate came from good principles and well-meaning economists at the US Treasury and so on. But it also came from public pressure. And so I would argue that we can't expect the Biden administration or any other administration to just do good things without sufficient public pressure from below.
Powerful call to action. Thank you, Professor Ghosh. And Professor Ocampo, let me just put in a final question for Mr. Rigo before I give you the floor. I apologize, but this just came in, and this is from Juan Manuel Barca from Del Clarín. He asks, how will the tax agreement affect Argentina, and can these changes encourage Argentine companies to seek investment in Uruguay?
Well, that is hard to say. We don't know because the global solution is not yet fully defined. We do not all the details. However, we are working, as we have said, towards a solution that is beneficial for our country, that is beneficial towards our tax system, that allow us to collect taxes in just taking into consideration the effects of the digitalization of the economy, and all the policies that we encourage are pro-growth and pro-inclusive policies. So we don't expect that if we reach a global solution that is beneficial for our country, I don't think it will have a negative impact on investment of local or international companies in Argentina.
Thank you, Mr. Rigo. And now to you, Professor Ocampo, you have the final word.
Well, thank you very much. And thanks again, the Group of 24 and Oxfam for also convening this meeting. Let me perhaps underscore that despite all these limitations, the fact that international tax cooperation has become an issue in the international agenda is positive. The decision to launch these negotiations, I don't think they should be under OECD, they should be under the United Nations, but that has been an advance. and it's likely that the inclusive framework will continue to be the main framework for discussions of tax cooperation. But let me mention that there are many pending issues. I mean, the pending issues on corporate taxation, which is what is being agreed, are immense. I mean, but in Pillar 1, we have fractional apportionment introduced for the first time, but with the threshold of the firms that will be subject to that, and the proportion of residual profits that can be shared is too low. So I mean, those are pending issues to negotiate. For example, to reduce the threshold, perhaps to think of a different way of a measure, proportion of fractional apportionment that is shared with the producing countries, let's say. In Pillar 2, I think it's in advance that we are going to agree on the global minimum tax. But as we have also pointed out, the share for developing countries and in general for countries where production takes place is difficult, and there have been these proposals of the G24 of what has come to call the subject to tax rule, which will allow the producing countries to participate in the taxation through withholding taxes on services and capital gains. This is another issue that is pending, as well as the threshold, again, to which the firms are subject to this. And then there is the dispute settlement associated to Pillar 1, which which I think is as Yayati pointed out, is outrageous from the point of view of developing countries. I hope it is not accepted in the final negotiations. Now, but aside from all of these issues, there is the issue of personal income taxes by the rich, which is the main problem associated to tax havens. Is personal income taxes. This is an issue that has to come into the agenda. How to avoid tax evasion, because it's not tax avoidance, it's tax evasion, period, from the very rich people. And this is perhaps associated to your questions about some of the Caribbean tax havens, but it's also associated, by the way, to the question that was made to Raul about Uruguay, competing with Argentina. It's also the question, by the way, of my country, Colombia, with the neighbor Panama, which are places where the effectively operate in some cases are tax havens. So these are many pending issues, which in those two cases that I have mentioned, also emphasize the need to complement global tax negotiations with regional agreements that try to avoid some of the worst effects of tax avoidance and tax evasion. Thank you again for convening the meeting. Meeting is it's an honor for ICRIC to co-share this event.
Thank you so much, Professor Ocampo. Thank you to everyone that has been here with us today, and especially to our brilliant speakers for their extreme generosity in sharing their time when their agendas are so busy, as we know. On behalf of ICRIT and the G24, I would like to thank all, including the journalists that have joined us today. Your voice, your analysis, and your critical understanding of these challenges in the global tax reform will help greatly in how it gets understood everywhere. Please don't hesitate to get back to us in search of more information. This session is, as I said before, is recorded and is going to be on the ICRIT website. We will all be following closely the developments. And let me just add, from Oxfam's point of view, we simply cannot afford a global tax deal that creates more inequalities between and within countries. This is an ultimate chance to address historic imbalances on our international tax system, and we simply should not miss it. Thank you very much for being here, and thanks again for hosting this event, and have a great day.
Thank you very much. Nice being with all of you.
Thank you. Thank you, everybody. Bye-bye.